Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken. Our model portfolio is up 13.93% year to date. Today's date is December 23rd, 2023. We have a green signal for the stock market strength color signal, and the S&P 500 buy and hold investor is currently up 23.70% year to date. Extremely impressive returns for the S&P 500. Our goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. This year I'm not going to do that. There's no way that I'm going to beat those returns, even though I tried my darndest to do so. Here are some past results for our model portfolio, and we have had really good results in the past. Last week, the S&P 500 gained 0.92% for the week. You can see that the amazing run that we've had over the past 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row with all green candles. Not one red candle for the past 8 weeks. So we're expecting a red candle either next week or the week after, because as they say, trees don't grow to the sky. Eventually they will top out. Last week we made no trades. Here are some of the recent trades that we've made. I have 2 open positions. I currently have 200 shares of SPY, and we are profitable by $6,092 in that position. And we also have a covered call. Now this covered call is in the money, so that's why it's showing a negative number right now, because I'm looking for a pullback in this market, which will make that this is the current price of this exact covered call. So this price will go down, and I'll be able to close it with less money than the current price. Here is the equity curve for the model portfolio 2023 year to date. Here is the equity curve for the S&P 500 for 2023 year to date. And here are the 2 equity curves combined. We always want to compare our model portfolio against the benchmark of the buy and hold investor S&P 500. I put the portfolio very conservatively 8 weeks ago after this great run. I was looking for a little bit of a dip. We never got that, and the S&P 500 has continued to incredibly advance. This is the FOMC, that's the Fed Chair Jerome Powell. So 2023, here are the meetings. The last meeting announcement was December 13th, and that was a skip. This is the FOMC for 2024 meeting schedule or calendar. So the next announcement will be January 31. Now, this is an election year. Normally, the Fed does not want to influence or even have the appearance of influencing an election. So most likely, especially as we get closer to September, he's going to be hands off. He probably will be hands off from April to September. So if there's anything that's going to happen, it's going to happen either in January or in March. Now we're looking at things from the presidential election cycle theory. This is President Biden. He's the current president. This is his 3rd year of his term. This is 2023. Historically, the S&P 500 averages 16.3%. The NASDAQ 100, symbol QQQ, averages 32%. The market is currently up 23.7% year to date, allowing room for this market to drop, about 6 percentage points before reaching the historical norm. Now we're looking at things from the bond market outlook. The bond market is saying stay out of the stock market. We have an inverted yield curve, not good for equity investors, and we have rising interest rates. Okay, now we are looking at things from a valuation standpoint according to current market valuation CMV. They are saying that the S&P 500, or the stock market in general, is overvalued by 52% above the modern era average for the PE. That puts us on a standard deviation chart at 1.3. Now we are looking at CNN Business Fear and Greed Index. Here's our friend Warren Buffett, and we are at extreme greed. Now, according to this, it says 1 week ago we were at 80, and we've backed off a little bit. Last week when I did this analysis, we were actually in greed, so I don't know why there's a discrepancy here. Now we are looking at things from a seasonality outlook. Currently, we are in the month of December. Historically, the month of December has a 70% probability of closing the month higher than when we opened it, going back 20 years. Currently, for the month, we are up 4.2% for SPY. Historically, the S&P 500 averages somewhere between 7 and 10% on an annualized basis, depending upon how many years you want to go. Currently, we're up 23.7%, giving plenty of room for this market to come down and still be historically positive. Now we are looking at things from a long-term outlook. This is a monthly chart going back 20 years for symbol SPY. And we're in a bull market as long as we stay above this line, and basically the MACD is positive as well. So all of these things combined are telling us we're in a long-term bull market. Now this is an intermediate term outlook. We're overextended by using just normal valuations by how many weeks in a row we've advanced. Going back for the past 5 years, maybe this one here is how many weeks you see similar to what we have right now. There's not that many of them with such an advancement. And eventually we're going to get some red candles, and we don't even have one red candle yet. Now we're looking at things from a short-term outlook. This is a daily chart going back 6 months. And here we're in this wedge kind of a formation, and it's getting a little bit closer and tighter here at the top. So the MACD is definitely at a high level. I'm going to show you that in the next chart. Oh, by the way, I did a Fibonacci extension. You can see grabbing it from the bottom to the top right here. So retracing 38 to 61% would be would still keep us in this bull market, and it would be considered a normal pullback. The stretch between the 50-day moving average, which is this green line, and where we are at right now, we're just like way, way high. And it's a irrational exuberance is really what it is. So coming down to at least the 38.2, which would bring us in line with close to here, at an absolute minimum on the pullback, would be within industry standards. Now we're looking at how overextended the MACD is. The MACD is way up high here. And when you look at how high it is right now and all the intersections that we've had going back for, I think, 5 years now, although I went and did this chart even before 5 years. I looked at this going back 20 years. They've only had touches in the last 4 to 5 years. And here are the touches right here with these lines here, the vertical lines intersecting. And you can see that we've had pullbacks, generally speaking, happen after that intersection. So we're expecting, here it was a small pullback, but we're expecting some type of a pullback to come here. Trees do not grow to the sky. Now we're looking at a risk-on indicator. This is a ratio chart for the NASDAQ 100 to the S&P 500. We have a bearish divergence. On the MACD, you can see that we've made a lower high, and here we've made a higher high on the ratio chart. Technically, that is a bearish divergence, and so we would expect this to come in suit to follow what the MACD is predicting, which would bring this down. Now we're looking at another ratio chart of the equal-weighted S&P 500 to the normally cap-weighted S&P 500. And we've fallen off of a cliff 3 times in the last 20 years. Then the last 2 times we've had some sideways movement for months. Here we just started our sideways movement, and we're at the top of that sideways movement. So we're expecting some back and forth here, further increasing the odds that we are going to get a pullback in the S&P 500. Now we're looking at the VIX volatility index, the fear index. There are 3 ranges that I've established: the ultra low range, a low range, and then this higher range. This blue line is the S&P 500. We are way up here, and the MACD just started to bottom and coming off of its bottom that just started. So if we start to come up and if this starts to come in here, that it's going to bring this S&P 500 down. Now we are looking at the Think or Swim platform going back for 5 years on a weekly chart, 5-year weekly. S&P 500 standard deviations, +2, -2 in gold, +2, -1, +1, -1 in pink, regression line dashed green. We are on this chart at the 0.1 5-year. So from this chart, we can actually go either way, up or down. It's got plenty of room to go in either direction. The long-term outlook, you can tell by the standard deviations slanting upward, tells you that you're in a bull market, at least going back for the last 5 years. Now we're going back 1 year, daily chart for the S&P 500. See the slant of the standard deviations, and that puts us here at 0.8 standard deviations. We know that 68% of the time you're going to be between the +1 and -1. We haven't even reached the +1 yet on this chart, and it looks like it's starting to top out. Now we are looking at a 6-month chart. You'll notice how the standard deviations are much flatter on this chart. Where is the S&P 500 in relationship to this chart? It's at 2.0. So for the last 6 months, we are at the upper end, which is a sell zone for us. We have been in a sell zone for weeks, and we are still going to hold on to that, and we are going to wait till this thing comes down and corrects. So I've got the buy zone around the regression line. That may be adjusted depending upon when we see the market starting to show some support. But we're expecting some type of a pullback and then further advancement. So we're expecting to buy and close out our in-the-money covered calls once we see something like this, a pullback and some sideways action. Now here we are showing you the stock market strength signals. These are the 11 sectors. These are asset classes. The asset classes are improving. So last week we got 77%. This week we're at 81% over multiple asset classes. So we're giving this a green signal. Also for the 11 sectors of the S&P 500, and here we have the S&P 500 all by itself, but here's breaking it down even further to the sectors. We have an 84% last week and an 84% this week, but still anything up 61 and higher is a green. Now we are looking at the 1-year chart of the 10-year Treasury bond yields. Here they are on the candlesticks. They've come down, possibly reached a support level. MACD is undersold and it's bottomed. It looks like it wants to curl up and come positive. Well, if this does go positive and these start to go positive, that S&P 500 is going to go negative. We have a holiday next week. Monday, the S&P 500 will be closed for Christmas Day. And now I've just given you a ton of information for this video. Now comes our critical thinking. What are you going to do with all that information? As of December 23rd, 2023, the market summation, according to me, Ken, your friendly host with SPY Trader Now, I am still in the same position I was last week. Nothing has changed for me. I'm still holding my in-the-money covered calls. I have an advantage if the market pulls back. If the market pulls back, I am going to be making dollars while the stock market is losing dollars because I have an in-the-money covered call position. So I'm going to choose option 1. I'm going to stay the course. We're 8-week green candlesticks. I'm expecting some red candlesticks coming up here. I mean, statistically speaking, that will happen. These are some of the other options. I'm not going to do those other options. I'm not bad with my whole position and with my strategy. Even though the S&P 500 has been much better this calendar year, this strategy is still a good strategy. I still have a return right now of 13.93% year to date. I still have $14,000 in cash. So all in all, everything is okay. I'm fine. I have cash to make decisions. Once this market begins to pull down, I can change things up. But I didn't accomplish my goal. So I have to give credit where credit is due. The S&P 500 buy and hold investor was in 2023 a good strategy. Absolutely. Better than the strategy that I'm presenting with this model portfolio. I hope that you got something out of this video, and I hope you liked it. Go ahead and do me a favor and click that like button for me. Subscribe to my channel. Ring that bell to be notified when I post a new video. I thank you, and I wish you good trading.